When we're looking at first in, first out, our oldest costs are in cost of goods sold, and our most recent costs are shown in our ending inventory. So this is an example of first in, first out with those same bikes. We purchased 10 bikes, and we had in our beginning balance 10 bikes at $91. We purchased an additional 15 bikes at $106. Then on August 14th, we sold 20 bikes. When we're using first in, first out, we're going to sell the oldest cost first. So first we get rid of those $10 bikes at $91. Then we take the remaining 10 bikes of that sale from the $106. That leaves us 5 bikes at a cost of $106. We then add on 2 more purchases. So we have 5 bikes at $106. We purchase an additional 20 at $115, and then 10 more at $119. When we sell 23 bikes, we need to first use up the 5 that we have left at $106, and then we can move to the next most recent costs, which are the 18 at $115. That leaves us with 2 bikes at $115 and 10 at $119. Therefore, our cost of goods sold amount is $4,570, and our ending inventory is $1,420. Next, we're going to look at LIFO. LIFO is the opposite costing of FIFO. So when we use LIFO, we have the last costs go out first. So we start with the same bike example where we started with 10 bikes in inventory, purchased another 15. Then we sold 20 bikes. Of those 20 bikes, first we sell the 15 that we just purchased. And then we sell 5 of the 10 that were in our beginning inventory. We then purchased an additional 30 bikes. On August 30th, we sell 23 bikes. Those 23 bikes are going to be our most recent cost. First, we're going to sell the 10 bikes we bought on August 28th. And then we're going to take out costs of 13 of the bikes that were purchased on August 17th. Under LIFO, our cost of goods sold is $4,730, and our ending inventory balance is $1,260. With weighted average, we average our costs throughout inventory. So every time we add on a new purchase, we're going to average the cost of that purchase with the inventory that we already have in stock. So we see here with the 10 bikes in beginning balance. So we had 10 bikes at $91. We then purchased an additional 15 bikes. So instead of saying we have 10 at $91 and 15 at $106, we add up the total cost and we say we have 25 at an average cost per unit of $100. We would then update the average cost every time that we purchased inventory. So then on August 14th, when we sell those 20 bikes, we have the weighted average cost instead of the first or last costs. And we would update that cost every time we purchased inventory. So then we purchased bikes on August 17th. That brings our inventory up to 25 bikes, 5 at $100 and 20 at $115. We add up the total amount, divide it by the number of bikes that we have on hand, and get a weighted average cost per unit of $112. Then we add on our August 28th sale. We add an additional 10 bikes on August 28th, taking us up to 35 bikes total. We redo our weighted average cost per unit and get a new average cost of $114 per unit. When we sell bikes on August 30th, they will be sold at that $114 per unit. When we look at the different costing methods side by side, if we use first in, first out, our ending inventory on the balance sheet shows what the current costs are. If we are using last in, first out, then our cost of goods sold on the income statement shows the most current costs. And if we're using weighted average smooths out price changes over our inventory for the entire year. We recognize that inventory can cost different amounts at different times, depending on if we can get discounts, prices go up, if there's higher demand, or a shortage of inventory. So we can see them side by side here. So because prices change, inventory methods almost always assign different cost amounts. So we have different cost of goods sold and different ending balance on our inventory under every single method. Now we can see that there are tax effects of those costing rules because our cost of goods sold is highest under the LIFO method. If we use the LIFO method of inventory, we can reduce the amount of taxes that we're going to have to pay. So then because our cost of goods sold is higher, then our income before taxes will be lower than any other inventory costing method, and therefore our net income will also be lower. But we have less of a tax liability. So some companies use LIFO just for the tax benefit. I will say that IFRS, or International Accounting Standards, do not allow for the usage of LIFO. Only US GAAP currently allows for the usage of LIFO. Most places have moved away from allowing LIFO, which was most popular in the 70s. But there are still companies that have been in existence for a very long time that were using LIFO and continue to do so. So because of the tax effects of costing methods, the IRS requires that if LIFO is used for tax reporting, we must also use it for financial reporting. That only occurs under LIFO regulations. So, as I said, many companies and accounting standards are phasing out the use of LIFO, but US GAAP still allows LIFO for companies that were using it in the 70s and 80s to still use it. Some companies prefer LIFO because of the tax benefit. But if they're using LIFO for the tax benefit, they have to use LIFO in all of their reporting. The IRS does not always require that accounting rules follow the same rules as they do for financial reporting, which you'll learn in different things. There are different tax effects for different financial rules. But LIFO is one of those where you have to do the same within your company that you do for the IRS.